refresh.
That's good.
I'm not seeing it go live just yet. Oh, here we go. There we go.
That's good.
Perfect. Hello, everybody. Welcome back to the TraderLion channel. Welcome to the first ever kind of market outlook, where we'll be bringing on different traders talking about their weekend routines and also discussing the market conditions. To kick things off, we've got Jack Tacher. You know him as Alpha Charts 365. Jack, thank you so much for joining us and starting off the series.
Thanks, Richard. Appreciate it, man. Appreciate you inviting me on here.
Yeah, of course. And just so we're sure you guys can hear us, drop a 1 in the chat if you can hear me okay. And if you're able to hear Jack okay, drop a 2 as well. And while we're waiting for those responses, Jack, how's it going? How's it going? How's this weekend starting? You got any nice plans for July 4th?
Yeah, no, weekend's going good. It's a little bit rainy here down in South Florida, but yeah, so far so good on the weekend and July 4th. We're not really doing too much. I got a barbecue and hopefully jumping in the pool, adult beverage or two, and that's a pretty good July 4th for me. So we'll take it. I don't actually like to go out on the holidays too much, to be honest.
Yeah, keep it low key. Nice. Yeah, I think we're just planning on hanging out with some friends, maybe going on a hike or two. Taking advantage of the finally nice weather here in Seattle. So perfect. Well, let's go ahead and dive right in. And I'd love to just hear about your overall weekend routine. What do you do to assess the market conditions, and how does that help kind of inform you how aggressive you should be, in the markets next week?
Sure. All right. So, I mean, I always start with the averages, right? So I look at the SPX, obviously, and I think you always got to look at a couple different things when you look at index chart. One, obviously, price action, right? It's making lower highs and lower lows. That's obvious right here, right? So it's in a downtrend by definition. And then I also like to look at the moving averages, and I have 4 on this chart. I have the 9-day EMA, 23-day EMA, 50-day, and the 200-day SMA. So 50 and 200-day SMA, and is price above or below them, and are they going up or going down, right? And we have price below declining 50-day and 200-day SMAs, confirming the downtrend. There's not much more to say about that, right? The chart is speaking to its, telling to you that this is the market's in trouble, right? It's not really that smart to go long in this market S&Ps. And I like to look at the RSP, which is the equal weight, as well with all my index reviews, because I like to see how they reacted comparatively to the index itself. So equal weighted SPX, you see it's slightly above the 9-day EMA, and the SPX is also about the same. So they're reacting about the same. So there's not much information there, but sometimes you see that divergence. So either the mega caps are carrying the index and you see the SPX definitely outperforming, or sometimes you see the RSP doing better, and that tells you that this is more of a broad-based rally and that we're not, Amazon, Apple aren't carrying the index. So that's so I always like to look at the equal weight versus the cap weighted. And I think that's a really important thing to always check out, because it gives you a lot of information. And I do the same thing for all the other indexes. Look at the Qs, and it's got the same look to it, a little bit worse, because if you saw the S&P, they were actually slightly above the 9-day, and we have the Qs below the 9-day. It's also below this potential area right here. Came back, it retested, it failed, and went lower again. All the moving averages going down. It's a downtrend. There's not that much to like about that. I like to look at the IWM, index as well. This is an equal weight. I skipped over the QQQE, obviously. And actually it's good I brought this up now that I think of it, because you see this one hasn't broken down yet versus the QQQ, which has. So you may see that may be a little bit of a divergence there. We'll see. That by itself doesn't mean anything, but it's something to take note of. That hasn't broken this potential support yet. I go through the IWM. and this is actually one that I'm watching very closely because it's hitting these 2018 highs, 2020 highs. It broke below it, filled the gap, which is this orange line back here, and now we're back above it. So how this consolidation resolves, is going to mean a lot to me right here because it's right at that special area, so that's IWM, IWO. I like to look through.
So these are the
This
kind of
one,
smaller cap growth proxies. So it gives you a sense
yes,
of how small caps are doing, right?
right, exactly. So small cap growth. So basically, if people are getting aggressive in this market, I'm gonna throw volume on here too while I'm at it. If people are getting aggressive in this market, you should see, growth really outperforming. And I'm also looking at this volume because I wanted to mention that here too. Are we seeing, volume start to really pick up as prices starting to kind of rebound or not? And I think that we're in the or not. Price really isn't rebounding. Volume is really kind of subdued. It is summer months. It's July. We're into July now, so there's a lot of vacations and shortened weeks and all kinds of stuff going on. But yeah, but volume isn't really telling me that institutions are coming into the market right now, and seasonally that makes sense as well. So I like to look at the indexes. It gives you a good broad sense of the market, and then I also like to look at individual ETFs. Any questions about the indexes before I move on?
Yeah, there's no questions from the chat just yet. But if you do have any for Jack as we go, feel free to drop them down below in the chat. And Jack, I did want to ask you, do you kind of look at individual sector ETFs and kind of individual group ETFs as well? Because that can be one way that traders use to try to identify, what groups are outperforming. I mean, right now we've seen strength in China, K-Web. We've also seen strength in XBI, the healthcare related names, biotech. So I was wondering if that's something you look at as well.
Yeah, I do. I look at them. I tend to look at I look at them not for market health per se reasons, but when I look at for setups and for things I want to look at, I look at that relative strength because that's really really important to see what is outperforming. And like you said, Chinese names are doing well, and biotech's doing well, and
Yeah,
solar is maybe doing well, maybe not doing well. We'll see. And actually, I used the TraderLion relative strength line on TradingView actually to help me determine that. It's a really quick, easy way to visually see that type of relative strength. It's actually one of my tabs down here. Let's see, it's this one. That's Marcuso's
new
high
high.
lows.
Yep.
Yeah, new highs, and that's a MACD that I look at sometimes, and that's TraderLion right there.
Perfect. And
Yeah.
Sunil has a question actually. How much does index current state drive individual trade decisions? So, how much do you take the overall health of the market into account when you're deciding how to take individual trades?
Yeah. So the most important thing I think is that the market in general is in an uptrend,
Mm-hmm.
right? So because the weight of the market can pull down, 3 out of 4 stocks, or potentially even more than that, really. So yeah, that's a big deal about how aggressive I want to get long in general in the market. Once we get like a price above these moving averages, even if they're just flattening out, I'm looking at that point. Relative strength plays a huge role in my process because now I want to see who's leading the way out of the correction, and then I'm going to get aggressive in those sectors and hopefully the best names within those groups.
Perfect. And we've got another question here from Jason. Hello, Jack. Will you only take action when the index is back above the EMA 200, or do you just see the different stock setup and take the trade? So I guess, are you still taking trades in this market? And if so, how are you adapting because we're in kind of an overall longer term correction on a higher time frame?
Sure. So, I did try a couple of trades last week. Right now I'm completely flat in cash. Most of them were either small wins or small losses, and I kept the size small as well. So in a correction like this, so the 200-day moving average is, the big cruise ship, right? It takes a long time for that thing to really move.
Right.
But if I start seeing the 9-day crossing my 23-day, and both of them are starting to curve up and cross above the 50-day, which may be now starting to flatten out a little bit, that would be enough for me to try some potential setups, because I'm starting to see that change in markets and everything. So that may be enough to at least put on some positions. Now, if it turns back over, then I just get out and I say the market wasn't ready yet. It was a false start, whatever. But they don't have to be completely above the 200-day for me to try some stuff if I start to see it, recovering some.
Yep, perfect. And I want to ask you, Jack, what kind of, outside of just looking at the indexes, what other kind of indicators are you looking at? Because I know from obviously your excellent weekend videos, which I highly recommend everybody check out, you look at credit spreads, you look at some other indicators. So yeah, can you kind of walk us through those secondary factors that you look at and how you incorporate that into your market analysis?
And here with me. Sorry about that.
No, that's perfect guest for the show, I would say.
Absolutely. My wife got home, so she heard her walk through the door. So now she's like, oh, I gotta go. Anyway, so I like to look at credit spreads. Let's do credit spreads first. And so when I look at any ratio chart, I always go to a line chart and I get rid of these moving averages because I just feel like they cloud what I'm really looking at. So click everything off here. All right. So credit spreads. The idea between credit spreads is that I use IEI, which is 3 to 7 year government treasury bond, versus HYG, which is junk bonds. Okay. So the idea behind this is that, does the bond market want to be in safe government bonds or risky high yield bonds?
Right.
That's as simple as that. And as you can see, for the most part, we're in, pretty good trending sideways action in the bond market, in the spread. And then you see spikes like this. This was COVID.
Mm-hmm.
And so these spikes is a widening of the spreads, credit spreads of these two bonds. Basically, people want to be in this government bonds way more than they want to be in these riskier high yield bonds. So this is risk off in my opinion. And you saw this, back here, you see it over here, and you're seeing it again over here, right? Just recently, they're widening again. That tells me that the bond market is worried. They're getting more worried about what they see. It's a gigantic market, the bond market, which everyone, I'm sure has heard. It's way bigger than the stock market. And so if the bond market is getting very, very defensive, and hold on one second, I'm open up the store.
Yeah, no worries. And while Jack is helping out with his dog, any questions whatsoever, drop them in the chat down below. And I see a few coming in, and we'll get to those shortly. And yeah, that'd be great. And while we're at it, while we're still waiting, go ahead and leave a like down below on this video if you're enjoying it, and subscribe. Make sure you're subscribed to the TraderLion channel. We've got the conference coming up next weekend. Jack will be presenting the second weekend, so really looking forward to that. So make sure you're subscribed so you don't miss that. And Jack, back to you. No worries.
All right, yeah. So basically, as we see these spreads widening again, that tells me that this market's worried. So the bond market's worried about whatever could be coming, which is another reason why I'm not aggressive in this market. Because if the bond market's worried, I actually, this is one of the indicators I put more weight in than some others, as far as it goes. And again, just going back, you can see this was 2009, just the spreads widening, and just different places where it's done across the board. So so that's how I do that. Again, it's a quick and easy look, and the direction matters, right? So like even here, it's still elevated, but you see it's making lower highs and lower lows. Direction matters. Sideways is absolutely fine. That's a nice trending market in my opinion. So I like this look right here. That I thrive in these markets because things are going up. You could buy, you can even make mistakes in your buys, and chances are they're going to be okay.
Right.
And then this is the tough market right here.
Yeah. So is it a specific level that you're watching that it gets to, or is it more about, the spike and the trend of the line that you're watching? I think that's kind of what you're getting at.
Yeah. No, for me, it's I don't care about the level as much as, the direction, right? And because it's telling me, are they going more risk on or more risk off?
Yeah. Yeah, perfect. And there's a question here from Chewy, which I think is definitely relevant. Chinese stocks bottomed months before the U.S. Indices last 2008, and they eventually led the rally in 2009. Do you see a possibility of the same scenario happening in this market? And it'd be great to go to a chart of KWeb and other Chinese indexes, because those have been showing a little bit of divergences versus the U.S. indexes and the market.
Let's put my stuff back on here.
Yeah, no worries.
And okay, yeah. So KWeb, I was actually in KWeb last week a little bit, and I exited that position. But yeah, so it looks a little bit better. So here we have the 9-day, going up. You have a flat 23, but you still have this declining 50 and this flat to declining 200-day moving average. I think with KWeb, I think this $38, this 50-day, that's the key real move right here. Mm-hmm. If it could get above 30, we'll call it 39, I think that's really positive. And yeah, then it could, definitely come back in. And again, they're obviously not correlated with the U.S. Market, directly. So China can ease rates or stimulate or whatever they want to do on their end, and that could have a positive effect on their equities. But I'm definitely watching the Chinese equities. I don't trust them, so I will only play ETFs in China. I won't play individual equities. It's just risk management for me. I don't trust them.
Yeah, that makes sense. But if you're interested, I'm watching a few like LI, DQ. PDD has been acting quite well. That's another name to watch. So there's definitely kind of a theme where these have formed higher lows as the market is making lower lows. They're above their moving averages, while the stock market, the U.S. stock market, is below it. So this is definitely kind of an area of interest for me. I'm in a similar vein as Jack. There's a little bit of there's been a history of kind of bad financial situations with some of those stocks. I think a lot of people who've been around a few years remember LK, that had a tremendous blow up. So you just gotta be aware of that and manage risk either by using the overall index and trading that vehicle, or just keeping the overall position size lower than you might usually do. And you can kind of treat it the same as a biotech, which is another area that's been acting extremely well.
And actually, I was on the weekly chart on that one, Richard. But yeah, but there's your 200-day moving average right there around 36.81.
Yeah.
And again, but this level stays about the same. I think it needs to get above the 200-day and above this level, that $39, that hasn't changed for me to be interested again in this name.
Yeah, right now, I mean, looking at it through the lens of stage analysis, right now, we're in a stage 4 decline, but maybe potentially transitioning over to a stage 1. We still have to let that longer term moving average, the 200-day moving average, flatten out, have price, get back to that level. And then we got to see that breakout through that moving average. And then we can potentially start a new stage 2. But we're seeing those higher lows, as you pointed out on the chart here, and definitely kind of constructive action so far compared to a lot of stocks out there.
Yeah, 100%. I agree with that 100%. That's yeah, but again, you just never know what China's going to do. So,
yep.
Anyway.
And there's a question from BNet. What is the name of this chart again, just so he can add it to his TradingView watch list?
Of this chart right here?
I think it might be KWeb, or it could have been the credit spreads that they're discussing. But
okay.
Yeah.
Well, credit spreads was IEI, which is the 3 to 7 year Treasury bond. Then you put a slash and then HYG. All right. So that gives me, I change to a line chart, and it gives me what I'm looking for here. Yeah.
Perfect. And what are some other indicators kind of along the same lines as the credit spreads that you take a look at and incorporate into your process?
Sure. So I like the put call ratio, equity only. And a lot of people use the straight put call ratio. And I like the equity only better because it shows you where people are putting money to work and not just hedging their portfolios. So I think that they're both good. I just prefer this one. That's as simple as that. And in a put call ratio, it's a sentiment indicator. So I am looking for extreme moves. All this chop in between here really doesn't give me any signal at all. I don't care about this right here. What I do care about is these big spikes that get to extreme levels. I put 1.4 in there. You put 1.5. You could put whatever your extreme level is. I think right now 1.4 is what I'm looking at, because I've gone back historically and looked at where market bottoms tend to be and how they correlate. Um, and as you can see on the fear side, you don't get as many signals. On the greed side, you get a lot of signals. And I think that just shows how fear is a much stronger emotion than greed. We can stay greedy for a long time here and do very well. So right here, this type of signal, I'm looking, okay, maybe it's not the best time to enter a position, wait for a little pullback because we're kind of extended, but we're in a nice trending bull market. I'm looking for bottoms to look more like this. And I don't see that here. I just don't see that yet. I think we need a flush on sentiment for a true bottom to materialize. I could be wrong. Maybe we don't need it, but this is definitely something I'm watching for a true bottom to show up.
Yeah. And along with these type of indicators, are these, is this more important than price action to you, or do you always have to kind of confirm what you're seeing in these signals with, constructive price action, stocks bottoming, stocks setting up, that type of thing? How do you incorporate this into your process? How do you kind of weight the signal that the put call ratio gives you?
Sure. So all these signals to me are secondary to price action. Price action is 100%, the primary indicator. So it's definitely secondary. But if I see something like that looks like this, and then you maybe start to see some divergences in either some sectors or some groups that are starting to set up, maybe the market's going lower and these are starting to make higher highs, and we're getting this. Okay, well now I have like something that I can work with. Yeah, so they're basically we'll say confirming. But definitely not in the place of price action. But I want to see something like this. I want to see, that capitulatory type move, and then seeing sectors or stocks showing constructive price action, maybe making bases, right? Maybe making right sides of bases, and then you see this happen. Okay, now I can be a little bit more, aggressive or some more trial positions.
Perfect. And I was curious, do you look at any kind of breadth indicators like percentage of stocks below their 200-day moving averages or 50-day moving average? I think that's a really interesting metric in terms of, how oversold, which is kind of a dangerous word in my opinion, but how destroyed have stocks become to a point where we could be starting a bottoming process, which can take weeks, months, but we could be, getting to the point where that could be starting.
Yeah, I absolutely do. I like the MMFI on TradingView, but it's a percent of stocks above their 50-day moving average. So percent of stocks above the 50-day moving average. I have the 50% line in black just for, to know where that is. And this red area is maybe this, overbought conditions. And again, in bull markets, things can stay overbought a long time, and that's okay, right? I like to see this. This is great. This doesn't mean that this is bad. It just means that maybe it's not the best time to enter the market on position, wait for that little bit of a pullback that tends to happen when it gets up here. But we hit this quite often in bull markets. What I'm looking for in this type of market is under 10%, which is this green area from 10% to zero, right? And so historically, these extreme washouts for 10% or lower tend to be that capitulatory move. And so that's what I'm looking for. And we got it down to 12% or so on this particular indicator, but we never got that really pushed under 10. And so with that being said, people are still buying the dip in my opinion, and we're seeing here, some kind of recovery of it, which means that this bear market has more to go, because every time we dip down, you see the recovery. We dip down, don't get too far, and you see the recovery. Again, we're still making lower lows. Lower highs. But you see the recovery, and each recovery so far, last few months at least, hasn't been as good. And so I'm watching for that capitulatory move to under 10% in this particular indicator as a breadth indicator. Perfect. And see it's decent for what it does.
Yep, absolutely. And I looked at a very similar indicator in TC 2000, which I think it uses the 40-day moving average on the NYSE, but it looks very, very similar to this. And Jack, I wanted to ask you, given that we are in a pretty extensive correction, bear market even, what are some things that you're doing to make sure you're protecting both your financial and mental capital? So when we finally do get that turn where we were talking before we start recording, that there'll be some amazing opportunities out there once this finally, go settles down and we start a new uptrend. What are you doing to protect your financial and mental capital, your confidence, so you're ready to take advantage of those opportunities?
Yeah, I mean, so the best thing that I'm doing, I think, right now is either not trading at all or trading very, very small. If I am trying some pilot stuff like I did last week, I tried Olaplex, and got stopped out of that one and a few others. The point being is that I'm not really trading. That I think maybe that's the best way to say it. And if I am trading, I'm keeping my stops really close, where if the market does turn against me, I'm getting stopped out. And sometimes you get stopped out and then it goes right back up, and it's kind of annoying, obviously. But in this type of market where this downtrend is strong, right? You have to play defense way more than offense, right? In this market, you're going to play offense, right? You're going to keep your stops a little bit wider, and you want to stay in the market for as long as possible because this is a nice trending market. But I think in this market, the idea is defense. We're in a stage 4 decline, like you said, and yeah, until we start to make bottoms and higher highs, you got to just play defense. But I still scan every single night. I'm still watching the markets every day. I try to spend less time in front of my screen so I don't do anything stupid.
Yeah.
But at the end of the day, I run all my scans, and I'll be honest, they're not really producing a ton of stuff. They did last week a little bit. That started to, which is why I got in a few positions. But there's still, there's really not a lot going on there yet. But I'm keeping my watch list fresh. I'm watching relative strength. I'm looking at some particular, some setups and seeing how they react to the market. And I think we're not really even talking about, the tight price movement. Like price movement is still wide and loose.
So volatile.
Right?
Yeah.
Yeah. So volatile, right? Like I want to see tighter price movement, like it looks good, tight price movement. And we just don't have that yet. If we start to see price starting to tighten up, even if we don't get that higher high yet, but we're starting to see tightening up and starting to see, things happening, that would get me interested too, just that price movement alone.
Yeah. A few weeks ago, we saw kind of it start to tighten a little bit, and then we broke down from it. So, you got to manage risk pretty carefully. And Jack, I wanted to ask you a follow-up question. You mentioned how you want to be a little bit more aggressive in that trending market, that strong uptrend, but now obviously the conditions have changed. How did you sense that market environment was shifting? And how did you kind of approach where we started to enter a correction and see a lot of distribution in the market?
Sure. So one thing, my buys weren't that good, right? So
yeah. Feedback from the market.
Yeah, exactly. Feedback from the market. That was a big deal. And we got the wife indicator. Famously, November or whatever, I posted a warning to everybody on Twitter, and that happened to be pretty close to Doug on top. And then obviously price breaking down below moving averages. And I really do use the moving averages as an important indicator on this move right here. That right there was like, right back here in early January. And I can't say that I was completely out of the market and didn't still try some stuff in here, but that was a take note day, just really, really, life under the 50-day.
Yeah.
Once you get under the 200-day, like, if you weren't out up here, like, what were you waiting on now down here? And if you saw, we came back and retested 200-day twice. You got the, almost like double top, we could call this actually, right here, because then it broke down right here. And yeah, if you weren't, out of the market here, and then you failed here, then you failed here. Like, how many times does the market need to tell you that we're in a different market now?
Yeah. And we saw it in the individual stock names as well. Some of the leaders from 2020, 2021, they topped way before the market. The market was kind of holding up because, as you kind of mentioned before, the big caps were kind of carrying everything. And those finally kind of rolled over. We saw Facebook, Netflix really suffer some really large declines off the top here. And even, Google Amazon, those suffered, corrections as well. So you always got to be paying attention to the market leadership, how that's changing. And when you start noticing those breaking moving averages, when you're seeing failed breakouts from kind of looser bases, those are signs that you want to pay attention to. And you got to remember that risk management is job number one. You can't trade if you don't have capital. And during a corrections, you want to make sure you're staying as close as possible to those all-time highs. So when we finally do turn around, you're in a good mindset, both, mentally, you've got your confidence, but also you've preserved most of your capital. So you're ready to take advantage of that compounding that can happen during the next uptrend. I think that's really important.
Yeah, 100% for sure, Richard. It's like, I've traded poorly in bear markets before, and it's brutal. It just beats you down.
It's disheartening.
The confidence loss and the capital loss by itself sucks, obviously, but just you just beat yourself up mentally on why I do that. It's stupid. It's a declining 200 moving average, whatever. But even like not trading, you're saving so much on just on life. It doesn't age you.
And you can test the waters a little bit. Like I've been selective in my longs here. I'm not the biggest trader who loves a short. That's been amazing this year, but I've picked my spots and I've gotten chopped up a little bit, but for the most part protecting, lowering your position size and making sure you're managing risk along the way, being really selective with your setups, that's going to really put you ahead of the market when we're just in a decline like this and the environment just isn't following through. So let's see if there's any questions here. There's one here from Zachariah that I think is interesting. Do you use the VIX at all, Jack, in your analysis?
So I do look at the VIX. I use a line chart just to clean it up.
Mm-hmm.
I hate messy charts.
Yeah, it's nice and clean with the line.
Yeah. So what am I looking for in the VIX? And I'm not a VIX expert. I don't trade the VIX or anything like that, but I'm looking for just the spikes, right? And so what is the VIX? The VIX is a volatility index. It tells you how volatile they expect the market to be based on options and whatever. And I'm actually doing the whole definitions in my TraderLion presentation, that what the VIX does. But I'm looking for, are we in a trending market or are we in a volatile market? And so, this 20, this range right here, whether it's 25 or 21 or whatever, this range right here is more indicative of a trending market, right? And when you start to get these spikes above 27-ish, movements that look like this, that is extreme volatility and something that I don't do well in. Like some people trade really well with volatility and they're like, oh, I love it, volatility's back. I hate volatility. I love trending markets, right? I do much better in trending markets than volatile markets. But yeah, so you see it's making higher lows the whole way. And again, I think we need one more good spike on the VIX. And I know a lot of people are looking for this, not just me, as part of the capitulatory type process. But I do look at it. It's one of those things where I don't put a ton of weight in the VIX. But I am looking for, is it trending up or is it trending down, and so is volatility coming out of the market or is volatility entering the market?
Yep, absolutely. And there's a question here from Magic Trades. What 5 books did you find most helpful in honing your trading style?
5 books, wow. So How to Make Money in Stocks, that's the foundation. Minervini, Think and Trade Like a Champion. I just this past week reread that book. Phenomenal book. I haven't read it in a couple of years, and I forgot a lot that was in there. And
there's a lot of detail.
It's a lot of detail. It's really good. I like Weinstein's book. That's good. I love the Market Wizard book. The original one was excellent. And Reminiscent was a good book. I think I like Darvis' book actually a little bit better because a little bit shorter, just a little bit more, like my style of trading. And it's pretty amazing that he was able to do it while dancing around the world and with a week's late, information a week old or 4 or 5 days old. And so if he could do it like that,
what's our excuse, right?
Right, exactly. What's our excuse? So there's 4 or 5 books that I think that if you haven't read yet, I think that they are really good reads. But I think if you have how to make money in stocks for really that good foundation. I think Minervini brings it up a level and really refines that and gives you a good process in his book. And I think Market Wizards, those would probably be my top three.
Yeah, Darvis, I think that was the first book I ever read on the market, How I Made $2 million in the stock market. I think it shares so many key lessons that we all go through in like a nice succinct story where you're with him through the highs, the lows, where he made a lot of money, lost a lot of money, gave it back, learned more about risk management, learned more about his process. And I think it's an excellent read. Highly recommend it. And I think you even maybe read it with your daughter. I don't know if she stuck with it or was super interested in it, but what was that kind of like? Did she enjoy it?
Yeah, so we did read it, and yeah, they liked it. I'll be honest, getting a teenage girl to do anything is like pulling teeth. But
Yeah.
but yeah, they read it, and she's not terribly interested in looking at stock market and that kind of stuff. As a dad, I wish she was a little bit more, but I just keep introducing it to her, and not everything may stick, but little bits do stick with us, and over time, I think that'll be a success.
Yeah, maybe revisit it in a few years, and she'll have a different perspective. So perfect. And yeah, keep the questions coming in the chat, guys. There's been some excellent ones. And now I kind of want to transition a little bit now, Jack, away from kind of market analysis to your process on the weekends for finding ideas. So I love to go through your screening process. I know you use FinViz a lot. So tell us a little bit about how you kind of identify the areas of the market you want to focus on, and then ultimately, find setups that you like.
All right. So I tell you, one of the things I do every weekend is I go through, I have a whiteboard over here, all the sectors of S&P, and I go through each one, and I look at the TraderLion,
RS line. Yeah.
RS line, thank you.
Yeah.
TraderLion RS line, and this is versus the SPX. That's the default on it. I think I kept it that way. Actually, I haven't changed it before. I usually keep it versus the SPX. And so I'm looking at what is outperforming versus the SPX, right? So I just go through each one. XLF, no bueno, not good. And again, and for this, the direction matters even more than anything else. I'm not looking at any numbers over here.
Yeah.
XLI, let's just do this real fast, see if anything looks good. So that's flat, nothing special there. It's okay. Nope, nothing special. And see, it's breaking down, right? So that's interesting. It shows you so much weakness. Now, healthcare has been good. Let's see what it looks like on. Oh, there you go. So right off the bat, I know where I need to focus on healthcare.
Right.
That's easy. Save me some time tomorrow by doing this right now. XLC. Yeah. So see, I mean, everything is just not looking good. I'm gonna skip over XLU because I don't trade it. XLP. Okay, so staples are doing well. So staples and healthcare, both defensive sectors. So right there, we got a lot of information, right? Defensive sectors are doing well. So if I do want to play something on the long side, I think those are two places where let's look at XLB materials, and that broke down hard, man.
Yeah,
brutal. But look, for a while, the relative strength was good.
Yeah.
Now, relative strength is nice, but you still got to look at the chart too. Because as you can see, because it went sideways while the market was going down, its relative strength was beautiful. So you still have to make sure that you are in an uptrending, in a good looking setup. Nothing beats looking at the charts. That's really the most important thing. But yeah, so I'm going through each sector one by one, looking at that, and then I keep a database of ETFs that I've created. And then within those sectors, I look at thematic ETFs.
Yeah.
Because I want to know within, healthcare, is XBI outperforming, or, what's outperforming within those sectors? Because I want the best of the best. I don't want just, good enough.
Yeah. No, that's interesting. And it took you what, 30, 45 seconds to identify healthcare and staples were outperforming. So that's perfect. And what made you kind of choose more of a top-down approach, looking at, the sectors to the individual stocks versus, letting the stocks kind of direct you? Because I know that I've interviewed traders both ways who just screen for stocks, look for uptrends, and then let that steer them to kind of the group and sector that's doing well. But also there's many traders who favor the top down approach, which you just kind of had a great example of.
Yeah. So I do both, to be honest with you. I started doing more bottoms up approach and a little bit, but I guess I learned top down first.
Yeah.
When I entered the market. So I've always kind of done a top down type approach, and I like drilling down. I feel like there's something therapeutic in it. It makes sense to me, right?
Yeah.
And a lot of times, like, even what I'll do is I'll change this to XLV, and what I'll do here is, as I go through the thematic ETFs, I'm looking for the ones that are outperforming the sector that's outperforming.
Nice.
So that gives me the top of the top, the creme de la creme. And so XBI is starting to break that downtrend and go up versus healthcare in general. So again, I drill it down another, and then I'll look at XBI, all the names XBI, and I'll look at things that have good basis potentially. Now biotechs, I don't trade individuals. I'll just trade the ETF, but you understand what I'm saying.
Yeah.
But I like the top down. I like the drill down. Whether you're looking at a P&L, you could drill down, or a chart like this. It just, in my mind, it makes sense. So then you mentioned bottoms up. And so that's where my scanning comes in. And I scan every night as well. And I love scanning because, you can tailor scans to look for characteristics you want. Like again, I'll mention the TraderLion conference that's coming up. Like, I'm going to talk about an IPO scan I made. I want to just look for the strong IPOs within the last few years. So I have a scan specific for that. I have a bull snort scan based on Oliver Kell's bull snort criteria that I kind of refined for myself. I'm looking for that big volume institutional look. And what you can see as you run through some of these scans is sometimes you see, oh, look, there's a whole bunch of software names showing up. Oh, look, there's a whole bunch of healthcare names showing up. And so that tells you where the relative strength is just by looking at the sectors in your scan. Or if you see, oh, look, I'm seeing on the IPO scan that this name is showing up. And then on my bull snort scan, it also had a bull snort. So you see institutional involvement. And then maybe on a different scan, maybe on a pullback scan, oh, now I see that, had a big run and now it's starting to pull back a little bit. And so now I have it on multiple scans, the same name. Yeah. Now I'm really interested.
Yeah.
So I use both, and I'll be honest, neither one takes that long. Top-down approach takes a little bit longer to go through this process. But all in all, like you said, how deep do you want to go into it? I mean, I did the sectors in literally less than a minute,
right.
And I could do subsectors, within 30 minutes, I could have that done, to be honest with you, just because I'm used to doing it. But so I think I like both of them for different ways, and I love when you see overlap.
Yeah.
That's really that's good.
Yeah, I think I do a similar thing where I'm kind of using a hybrid approach. I also look at what sectors, groups are doing well, but it's important to scan just kind of for just price and volume strength, and that can point you in a direction that you might not be thinking about, and then you can find sister stocks that are acting well, and that's kind of what your bull snort scan is doing. So I think that's perfect. And there's a question here. I'm not sure their name, but they had a question about how you keep your stops tight during a bear market for swing trading. Say the stock is up 10% in 2 days. I'll show the question here. My answer to this would be, if a stock's up 10% in 2 days, you're probably a little bit extended from proper buy point. You want to wait for another consolidation, but I'd love to hear your take on that as well, Jack.
Yeah, I mean, so if you're up 10% in 2 days, take profit, right?
I think it's if the stock is up 10% in 2 days and you're looking for an entry point, I think that's what their question is about. Yeah,
that's an avoid for in a downtrend. That's a definite avoid. Even an uptrend, I mean, it'd be hard for me to enter a stock if it's up 10% in 2 days,
right.
Just because it's hard for me to manage risk. And you mentioned that yesterday in your interview with Alan on like an earnings gap, like how to enter that. I've struggled with that in the past because you're so far extended from where you can manage risk against. And I kind of liked what you said by using a the low of the day, basically, right? No,
Right.
you were saying
Yeah.
the low of the day. But yeah, so yeah, it's kind of extended. And again, I keep it small in these bear markets. I mean, if I even trade at all, like I said, I'm in cash now. It's a holiday shortened week. It's thin trading to begin with, and it's a bear market. I mean, you have 3 strikes against you, and that makes it hard, right? Yeah, but if it's up 10% 2 days, wait for the pullback. That's the best thing. If you find a low volume pullback and you want to give it a try, then you have something there maybe.
Yeah, perfect. Well, let's drill into some individual names. And if you have any requests, everybody watching in the chat, just drop them down below. We'll take a few here. And while you're doing that, make sure to leave a like on this video and subscribe to the channel. If you're enjoying this analysis, we'll be trying to do more of these, bringing on traders, talking about their routines, and teaching about their process. And also, we've got the annual trading conference coming up. The link is down below in the description. And I'll actually go ahead and post it in the chat. And Jack will be one of the speakers, really drilling down even more into his routines. And let me get that link up there here, as well as, some amazing speakers I'm really excited about. The lineup, we've got David Ryan, Mark Ritchie, Jack Schwager, the author of Market Wizards, which Jack was talking about just previously. And yeah, really excited for that event. And Jack, I think yours was one of the most popular last year. We had some amazing feedback talking about trading part-time. So really looking forward to hearing you speak once again.
Thank you, Richard. I'm happy to be there, and yeah, I mean the lineup that you guys put together, phenomenal. Like I'm so excited for it, just to listen to be to listen to everybody that's Ropal's on there and just amazing people.
Yeah.
So,
yeah, a lot of them are people I've interviewed before. Such great guys and girls, and they're so kind of giving with their information and sharing kind of decades of experience. So it should be fun.
Cool, awesome.
Yeah. So let's see. Yeah, we've got some suggestions here. First, take a look at Amazon. We'll start with some of the big caps. Start there, and then drill into some other names.
Yeah, we looked at Amazon right before we went on,
yeah.
And it's at a great spot, right? I mean, like it's gonna have to make a decision, right? Right. It's right on this potential, supportish area right here, and if it stays above 100, I think that's the bullish scenario, right? If Amazon above 100, I think the market's okay. Amazon loses 100, and I think that we have a lot more pain in the market in general because it's just such a big stock, right? You can almost use it as a proxy for the market in some ways. But let's go and just look at the recent price action. So listen, is this a head and shoulders type pattern that's kind of like forming, and the 100 level is its neckline? Maybe, I don't know, but price gets above, we'll call it 117, and you're gonna have some moving average starting to curve up, and you're back above the 50-day. So that's your bullish scenario. So Amazon above 117, I can see the idea of going bullish with using the 50-day as a stop. And then below 100, that's definitely the bearish scenario. Right now, no signal. It's literally right on support.
Yeah.
Yeah. What do you think?
Yeah, for me, it's kind of range bound, and we're still just in a stage for a decline. So this could just be a pause, a consolidation, and then it resumes downwards. Or like Jack said, we could move to the upside and kind of start a longer term stage 1 base. No one knows. Amazon has had a tremendous run. No one knows if it's over, but we'll only know in hindsight. But we can manage risk in real time. So that's the key thing. And you got to ask yourself, is this the top idea, the strongest stock in the market? And for me, Amazon just isn't that right now. So, don't go for C+ setups, D+ setups when there's A+ setups out there. Focus on the best of the best. That's going to pay off in the long run. And, the leaders of the next bull market, when it finally comes around, are most likely going to be names that we're pretty unfamiliar with. Amazon, it's had some amazing runs, but it's very tough for the stock to double in 6 months. Meanwhile, there's some smaller cap names that are 10 billion market cap, 20 billion market cap, 30 billion market cap, that they can double pretty easily and even do more than that. So that's kind of where my focus is.
Yeah, I totally agree with you. And plus, remember, all of this is overhead supply.
Right.
Yeah. So that's it has against it too.
Perfect. So Arthur Jackson has another suggestion here, Rel, and this is a name that popped up on my scans as well. So I'd love to hear your take on this, Jack.
See, I haven't seen this one yet at all, so it's brand new to me. I'm gonna go to the weekly just to see where it came from. Okay, so you know, it had a nice run, right? It
Mhm.
had a nice run here. Let's go to daily now.
The last week showing some distribution, in my opinion.
Yeah.
Yeah.
And it's got earnings coming up in July 20th or so. So a couple weeks, 3 weeks or so. Yeah, so it may have this, cup and handle type look to it. Now for me, it's underneath the 9 and 23-day EMA. So I don't buy stocks under the 9 and 23 and they're crawling down. So far it looks good. So how would, I do like that it looks like there's accumulation, thinner name in general.
Mhm.
So that plays a role into it too. But yeah, so I think that there could potentially, if I was interested, I would look for a break of a downtrend line for like a cheat entry if it gets back above the moving averages and breaks this downtrend line right here. That could be something I could possibly be interested in. If not, breaking out to new highs on some volume. But yeah, this looks like distribution the last 3-4 days or so, and then earnings coming up. So it wouldn't be something I would be looking to start a new position in. If somebody has been in it for the last weeks or months, and got all of this, so congratulations, that's awesome, but maybe not a new position for me.
Yeah, I agree. And yeah, there's been maybe some places you could cheat in here, but the positive is it's in a longer term uptrend. It's above the
Yeah.
200-day moving average. But right now in the short term, we're seeing that distribution, and we'll just have to see whether it can stick near those moving averages or it might roll over. So kind of a wait and see here. It's also kind of a lone warrior. I don't know the exact group here. But when I was looking at MarketSmith and spotted this one, the overall group wasn't doing so hot. So we'll have to see. It's right at that key resistance point. If it can build out and firm up and break through that, I think that's definitely positive. But right now, I think it's one to watch, it's one to have on your watch list, but not necessarily an 8+ setup. There's not too many of those out there right now, just because of the overall conditions. But that's something to keep in mind.
Yeah, and I'll be honest, 20 years, 22 years, this has held as resistance. Is this time going to be different? I don't know. You know
We'll
what
have
I'm
to see.
saying?
Yeah.
Yeah, we'll have to see. Exactly.
Yep. And there's a good question here, or just comment from Sid. Do you take liquidity and market cap into consideration? I do. I like stocks that are pretty liquid, that have dollar volume, at least 20 million. I prefer higher, 50, 60, 100 million. And that's basically calculated by taking the average price over the past, 10, 20 days multiplied by the average price, average volume over the past 10, 20 days. And that gives you a sense of like the liquidity, and institutions, they want that liquidity because, you can buy a stock and it can be liquid enough at that point, but they want to know that they're able to liquidate their position and sell without dramatically impacting the stock's price. So liquidity is a must for institutions. And I want to focus on institutional quality names.
Yeah. Yeah. I agree with you 100%. It has to trade, minimum for 300,000 shares a day,
Yep.
minimum. And I like the mid caps. I
Mhm.
love to focus on the mid caps. I feel like if you're really into growth names, they're big enough to really start to do something, but they really haven't been discovered yet by institutions, or they're on their radar, but haven't really had that big move. So 2 billion or more in market cap, that's where I like to start. And most of my scans, as you'll find out, will start at that point going forward, going out from there.
Yeah, I think that's a great range. As I was talking about, 10 billion to 50 billion market
Mm-hmm.
cap, I think that's a nice sweet spot. If you're going under a billion, it's a little bit, why is that company under a billion if it's such a good company? There's
Right.
that question. It's like a similar, why is a company under $3 a share if it's such a good company,
Exactly.
Yeah.
Exactly.
Yeah.
100%.
Yeah, perfect.
100%.
All right, we've got some more suggestions here from Say Hey Kid, SWAV and HRMY. We can start with Suave.
Yeah, I was actually just looking at one of my scans, and that actually was on there, and it caught my eye because again, it's a medical device, right? And we know that healthcare and XBI and whatever is doing well. Well, here you go, Shockwave Medical, newer name, right? Um, in a nice uptrend, went sideways, and yeah, I mean, so this looks pretty good. Good accumulation volume. I'm not sure what this was on this particular day. If it was the rebalance day, or what was going on this particular June 17th. Um, but Love that it's above the 200 day. Sometimes I'll just play around with lines and just see. Yeah. So, you could put almost like a trend line right there. And yeah, if it breaks above this trend line and all of this is bullshit lined, I love it. If it breaks back below, we'll call it 182. I think that'd be the out if that was, into your risk. But I like how, we went up, then we went sideways. And if you look here in the volume on this sideways movement, this pullback,
It's
right
pretty
into the
low.
moving average.
Yeah.
Yeah, that's real nice to see, that it was decreasing volume there. Looks good. Looks good. A little breakout above, gets above 200. I think you could use even that level, the 200 level, as a potential, stop. I'll be
Yeah.
honest, in this market, I've been using the shorter moving averages versus I like to use a 23-day usually in bull markets, but I've been using my 9-day as my stop in this bear market. I'm sorry, what were you saying then?
No, I was just gonna agree with you because I thought that was perfect. And you can manage risk versus Friday's low. I think that'd be a good spot. You want to think about where would the setup become invalidated? What spot on the chart would suggest to me that something is wrong, that the setup's not working? And for me, undercutting Friday's low or that Thursday low, which is kind of that intermediate swing low, that to me would say that breakout has failed. So you can set your stop there. You use that stop, account for that percent change, and then that's how you can set your overall position size. There's many ways to do it, but that's just one suggestion. But I think it's always important to remember that you want to buy close to a spot where you're going to be wrong quickly, because that way you can manage risk very tightly. So even buying Friday would have been pretty good, a little bit of an earlier entry, and you could maybe buy half on Friday, add through that DTL break, the downward trend line break, and manage risk pretty tightly versus that swing low and get a decent position size on. But yeah, those are just a few options, but you always want to think about where am I going to exit before you even enter the trade. That's the most important thing, and it has to be both tight and logical. If this was going to gap up 10% and go on Monday, and you're looking to buy it Thursday, where are you going to put your stop loss? There's no logical spot that's tight enough that allows you to really take a position. So you gotta kind of anticipate the moves a little bit, look for constructive price patterns where you've got big volume to the upside, consolidation, tightness, and a clear pivot point, and that's what you want to look for. And the best scenario for me is I find there's kind of more than one reason to buy. There's more than one reason why the chart looks good. And here we've got that downward trend line kind of lining up just with that high from, would that be Tuesday there? So you've got kind of multiple things lining up right at that 200 level, and you've just got that kind of Livermore 200 level as well. So you've got multiple reasons why that pivot point around 200 is a pretty good buy point, and you can manage risk pretty tightly. So that's kind of what I would say. It looks like that'd be about a 5% stop loss to that kind of swing low, Friday's low. So that's pretty good look. Anything to add on that, Jack?
No, that was perfect. That's exactly how I would look at this. And I would keep again into bear market, but this looks like one thing to realize is like it's above all its moving averages. Like we haven't seen that in many stocks. So I love that idea. And again, it just shows you how strong this name is. But yeah, I agree with that. Keep it tight, because as you can see, just because it looks great doesn't mean that
Okay.
it can't destroy you.
Exactly. Yeah, you want to go, it's maybe a little bit pessimistic, but you want to go into every trade expecting for it to be a loser and being okay with the loss you're going to take. And you got to set your stop loss accordingly. So if you do that and manage risk tightly, just one winner can pay for 3, 4, 5 losers. And that's where you can kind of build in that edge based on your risk reward ratios versus just having to be right all the time. It's really, really hard to be right 70% of the time, 60% of the time even. But if you can average on your gains 3 times your average loss, you only have to be right 25-30% of the time and break even or even do well. And when the market's really ripping and roaring and you're right 40-50% of the time, that's where the compounding does its magic, and that's where the good stuff happens, and you really can compound your account. So I think that's really important to remember.
For sure. HRMY, I think, was the other one, right?
Similar look here, similar setup. Yeah.
Similar setup. Yeah, it's trying to get to all-time highs. That's again something that you don't see too often in this market recently. So that's always nice to see. It is a biotech name as far as biotech name. It was actually also on the scan I was looking at, which is kind of funny. But yeah, so great looking name. And nice thing about here is you can manage risk if it gets above, we'll call it 53 versus the horizontal, or if you want to, again, you have the nice run up, the pullback, you see the lower volume on most of that pullback, which is nice. Again, Friday, I'm not worried about this volume right here because people were going on vacation, right? It's a long weekend. Like, so understanding that, it's a long weekend. So yeah, I mean, I like the name. I think it looks great. I would probably, if it gets above 53, I would say you enter 53, and I'd probably put my stop really close to that level, just because if it comes back below to 52, I'd be out for sure.
Yeah, I think this name looks good. Everything that Jack pointed out, I agree with. I love maybe an inside day Monday, and then you could kind of manage risk versus that inside days low if we get a push through that level. But any stock that's this close to all-time highs during a correction, you want to be paying attention to. And this is in an area of the market that's acting well. We've already talked about the strength in healthcare, biotech. And William O'Neill says in his book, 50% of the stock's move can be directly attributed to the health of the strength of the sector and industry group. So you want to pay attention to that and focus on the strongest stocks in the strongest groups in the strongest sectors. And that's how you kind of have the tailwinds working for you. And that's where you can make a lot of progress and really key in on the leaders of, the market. And if there aren't any, that's telling as well. That's telling you that the correction is going to need more time to play out. And we're just starting to see stocks emerge within this biotech group over the past few weeks. And there's not that much out there. There's some China names we've talked about a little bit. But, in terms of the health of the market, I'd love to see, more and more groups start to emerge where, they've got great earnings. They've got new and innovative products. They've got great sales growth, institutional sponsorship. Right now, it's mostly in the biotech area where we're seeing setups. So I'd love to see kind of breadth expand a little bit. And we were starting to see that, and then we took a hit again. So we'll just have to see how it goes. But yeah, perfect.
This was on the scan too. Yeah, not as good. Not as good in the area.
Yeah, a little bit more overhead supply with this one here. Yeah. I think this was my pick for the year, Cubby's yearly performance challenge. So it's not doing too hot, as you can see. Yeah.
I forgot what my pick was, but it got destroyed, whatever it was.
Yep.
Totally destroyed.
Yep. So there's a question about WRB. I think is that H&R Block? No, it's not. It's
WR Berkeley Corporation.
This could be an oil, or is this an insurance? The name is pretty familiar here. Yeah.
I don't know. Maybe first time I'm looking at this one. Let's go to weekly just to see where it came from.
Yeah, nice uptrend.
Yeah.
Looks like a slower mover, more mature company.
Yeah. Let's take a look and zoom in a little bit.
I wish TradingView kind of auto scaled. It'd be nice.
Yeah. Always fiddling with that. So you got a spot there where it just kind of broke out of this big area right there. And then, yeah, I mean, so I kind of like the bunching of the moving averages right here. That's definitely something I look for in price above it. And because it gives me a nice spot to manage risk against, right? So I'd probably use the low of this day, which means that it definitely had to violate all these moving averages and the low and the low of the day. And that looks, that'd be interesting right there. Again, is it, like you said, it's a slower move, or you could just tell through its price action. It's not bad stock, right? If that's, if it's making money, who cares, right? Decent accumulation, pays a dividend, whatever that is, 60 cents. It's not bad. Yeah, I mean, looks fine. Earnings coming up on July 21st. Yeah, I like how it looks. Again, I'd manage risk right in this area though, keeping it tight. I don't think it's one of those ones though where if it goes against you, it's not going to kill you. It doesn't look like it's going to kill you. Like a biotech could kill you. This one looks like even on its gaps downs, that was a 2%. It ended up down 2%. Right? It's not going to hurt you that much. And it pays a dividend. So
yeah, it's in a longer top trend. As I said, it looks like kind of a slower mover. I like to see it maybe tighten a little bit for a few days and then set up a pivot of some sort. But overall, the chart looks constructive, especially considering the environment we're in. So Perfect. And there's a question about when would you use intraday charts, and Jack, maybe you can touch on that one first, if you do use them at all.
Yeah, I mean, so sometimes I'll look at intraday charts if I want to see like if there's a lot where the supply is coming in. I'll look at actually intraday volume probably even more than price action just to see what it looks like. But I really don't. I like to stick with daily and weekly charts. If I do intraday, I usually keep it to 65 minute or sometimes I'll go to 30 minute just to peek in there. But I make my most of my decisions based on the daily chart, to be honest with you. And again, and it goes with my style of trading. Like a lot of times I may be at work, so
Hmm.
I can't hit an intraday chart and really use that in my style because it's just not possible. So that's why I've really stuck to the daily. How about you, Richard?
Yeah, pretty similar. I really like looking at the 65-minute chart when the stock is set up on the daily and weekly. So I'm always kind of deferring to the higher time frames to looking for a setup there. And then if the stock is set up, then you're allowed to kind of narrow it down, focus a little bit more in on and use those intraday charts. Because if it's not set up on the daily, why are you looking for a setup on an intraday chart? It doesn't make sense. You want to align the time frames and buy at a point where you're expecting a large move one way or the other, and you can know very quickly if you're right or wrong. And if it's not set up on the daily and weekly, it's tough to get a large move to the upside or the downside if you're shorting. So I always say, focus on the weekly and daily. Then if you find a pivot, then you're allowed to look at the intraday timeframes, maybe manage risk there if you're more of a swing trader. But you don't want to go too narrow as well. You don't want to be looking at 1 minute charts, 5 minute charts, because there's so much noise. The trends are up and down. So I like the 65-minute time frame for me, which I think I'm a little bit quicker in terms of my time frame than you, Jack, is a nice spot. The moves are still significant. You can see volatility contraction on the intraday time frames often before the breakout. So I like the 65-minute time frame, but I'm always waiting for a setup on the daily or weekly chart, and then you're allowed to look at the intraday. That's something I learned from Oliver Kell. I thought that was a really key lesson that I took away from his masterclass, and I think it's really important to remember because I think especially in this market where there's not really that many amazing setups, people are looking for setups on the intraday without considering the trend on the higher time frames, and that can work against you quickly where you're going right into resistance, or the overall chart is just seeing distribution, so the odds aren't really with you. So you always want to be careful looking at the intraday charts. William O'Neill mostly used the weekly chart, and he was able to do phenomenally well. So keep that in mind, and don't get sucked into the noise and needing more and more information. Keep it simple. Look at the weekly, look at the daily, use a few moving averages to gauge the trend, and just look for those same repeated setups over and over again in strong stocks, in strong groups, in strong sectors. So
Yeah, yeah. I just put on this little indicator that I use sometimes, and I don't trade the strat, but I do respect all the people that do. And I got this from one of the strat indicators, and it
mhm.
just tells you on the daily, weekly, monthly, quarterly, yearly, is it up or down. So it's a real quick look if you want to see what the longer time frames, what they're looking at. So whatever you put in there, it'll just show you daily was up, weekly is down, monthly, quarterly, yearly. And so it's something that I'll peek into a lot of times, and it gives me just a really quick look at what the trend is. you
Mhm.
know. So just want to add that on there.
Yeah, absolutely. And there are a few questions about, Jack, how you're handling your position sizing right now. Are you adding to positions if they work for you? How are you handling those type of decisions in this type of environment?
Yeah, well, I mean, like I was in Olaplex, right? And this one went against me, right? So I think I bought it. I don't remember. I think I bought it probably on this day, or maybe even. I think it had to be on this day. I think. Um, so yeah, so I kind of liked the way it was looking. I liked the volume, kind of like this inverted head and shoulders that was coming back around here. And so that's where I wanted to try it. It was either this day or this day. I don't remember where I bought it at, but I kind of liked it. That was coming through probably this day. Anyway, so I put my stop below the moving averages down here, and it failed on me. Now it was a small position, right? Because I'm not going to take a big position in this market because the market weight is against you. So just zooming in on this position a little bit, you can see that once it took out the VWAP from the earnings day right back here, I felt like that the position was dead. And maybe it sets up again, maybe it doesn't. But you see the next day it was down another almost 5.5%. It's come back a little bit since, but still underneath all the moving averages again. So I was out. So how do I manage it? I like to look for things that are close to the moving averages, and then I will put my stop below a moving average or important VWAP that could be important. And as long as they're reasonably close by, I'm trying to keep my stops to 3% or closer. And I know that's kind of tight, but in this market, it things can go against you very, very quickly. And so I don't want to get caught like that. In a bull market, I usually don't keep them that type. I'm more that 5 to 6% stop. But in this particular market, I'm keeping them much tighter because you could go from let's see what this is. It went from up here to down here. It moved 12% in 3 days. And you don't want to get caught up in this. And so I took a little bit of a loss in there, but it wasn't terrible.
Yeah, I think everybody wants to find the bottom and pick it, but it's important to remember that even if you are able to pick the bottom in this market, like if you're able to buy close to that May 14th candle, you still have to deal with so much chop up and down in this type of environment because the market just isn't providing a tailwind in this environment. So you're easily going to have these pullbacks and up and downs and swings and all of that. So you got to manage risk tightly and keep it a little bit smaller. In this market, my initial position size is about 5%. In a strong trending market, it's 10%. So just managing risk that way by position size, it's a good way to lower the volatility in your account and focus on those A+ setups versus just trying. This stock looks good. It was a winner for me in the past. I'll give it a shot and see what happens. And don't try to pick bottoms because it's so difficult, and you're not even going to make the most money picking a bottom. Instead, in a strong uptrend, when you find a spot where you can really manage risk tightly and you can increase your position size, that's going to pay off more than trying to pick a bottom with a 2% position just to say you got an amazing winner right off the lows. That's kind of ego. At the end of the day, we're looking for a rising equity curve. It doesn't really matter if we pick the bottom. Just pick a spot where you can manage risk, and that's the most important thing.
100%, right? It's about making money. That's it, period.
Yep. Let's see. There's a few more questions here. Keep those stocks coming. I think we'll do one or two because we're actually going a little bit longer than I thought. Jack, is one or two more stocks good for you?
Yeah, that's fine. Cool. Perfect.
Awesome. So we've got a request for ATGE from Jerry. I haven't looked at this name at all. We'll see what it looks like.
Adtalem Global Education. Okay. So let's go to weekly. All right, so it's name that's been around, and it's been just kind of like in this broad choppy area. So let's go ahead and get it. So it's had nice movement here, and I do like how it's kind of flagging like this, which is really nice. And you went from 30 to 37 or so. 37, 42. Yeah, I mean, maybe if it can break out, if this flag confirms, it's got, decent volume coming in. I'm not sure what its story is or anything like that, but it's right into this choppy overhead area right here, and maybe even a little bit extended from its moving average. I like how they're fanning out, and that's a nice look to it. But maybe needs a little bit more time to just kind of consolidate in here, let these moving averages catch up a little bit. It's not bad. I mean, it's not bad. I mean, it's above all its moving averages, and they're all moving up, and I kind of like this general pattern. Decent accumulation on the volume side of things since this earnings. Would have liked to see this earnings gap close near the high instead of the selling coming into it, but it is what it is. And let's just see where the VWAP is. And you got a VWAP all the way down here, so that's fine. Yeah, I mean, so it doesn't look bad. I mean, nice looking names. Just you may just come into some resistance, with some supply issues right above where you're at now. That's my only thing.
Yeah, I have a hunch that this is maybe a China name. It kind of bottomed in March and has been forming higher lows. Looks similar to those other names, but yeah, exactly right. Because that overhead supply. If you think about the psychology, all those people who bought during that time suffered a decline to 19, and if they didn't sell, they're seeing it finally back at break even, and psychologically they might just want to get out at break even, wipe their hands clean of the trade and walk away. And so that supply being introduced to the market can be a headwind for a fast move up, which is what we want as traders. So something to think about.
For sure. Yeah, I think if it breaks above this general-ish area, that's a long ways away, right?
Yeah.
It's a long ways.
And jazz was suggested here. That's a good one that came up on my radar. That's probably going to be on my weekly watches video. So that's a pretty good name to watch. Actually,
company. Go ahead.
Yeah, maybe this wasn't the one I was thinking of, but this is a good one to go through as well. Okay. Nice long base.
Yeah. So, this one came out and went to 54 cents. That's brutal. And then it came all the way back. So I guess they finally figured out whatever they were working on. And looking at this, see, did a reverse split or anything? I don't even know. But either way, it's a biotech, so I would be careful with this one in general. Again, very choppy. I mean, look how this can move, from cut in half in a very short period of time, relatively. And so there's a lot of people in here. Enough volume in there, and just digging in a little bit closer.
A little choppy.
Yeah. So yeah, choppy, right? Choppy, loose price movement, right? That's the first thing that just jumps out. I like to, there's not those tight candles that I personally like to see. As it's moving up, you're getting a decline in volume. Again, not the ideal situation that I want to see. You're also having mixed signals with a declining 50-day. You have the 200 days starting to move up, actually, which is kind of interesting. And these are moving up, but you still have the declining 50-day. So lots of mixed signals, choppy price movement. And as it's going up, you're getting a decline in volume. So there's some caution signs in this one. Again, if it's your thing and you think it's going to change the world and stock is going to go through the roof, just be careful with your stops. It has, I can see the merits of it, but is it one that I'd want to enter? No. I mean, for being biopharmaceutical and for the other things I've said.
Perfect. And lastly, let's talk about GO, because the discount stores have been acting pretty well, and this has been in a really nice trend. So I'd love to hear your take on this one, Jack.
So grocery outlet.
I've never seen one in real life, to be honest. So
yeah, me neither, actually.
Yeah.
Yeah, I mean, so it's getting close back to all-time highs. Not quite there yet. Decent volume coming back into this. And now it's just kind of, when we talk about this tight price action, I like to see this is fairly tight price action right here. That's kind of nice. So it's not giving back that much. It's just going sideways, letting moving averages catch back up. Now you're seeing the 200 days going from a flat to declining 200 day to an uptrending 200 day. Again, that's awesome. That's what you want to see. I like the way this one looks. Again, every time it's kind of gotten up to this area, and I can even maybe move this a little higher, it's kind of backed off, right? So what would I be looking for here? I would love to see some kind of VCP type action, that would be pretty cool, actually, right here, or maybe just some more tight price action, let these moving averages catch up a little bit more on this declining volume, which would be nice. You know what I'm saying? So that would be good if it moves sideways on some declining volume and then maybe a bigger volume breakout. I would like that as well. But it looks pretty good. I was watching Ollie, OLLI as well. But these discount type plays seem to be going pretty good. What do you think about this one?
Yeah, I like it too. Could you zoom back in for just a second?
Of course.
Yeah, so this has been on my radar for a few weeks. I haven't traded it, but it's been very constructive. I love the price action where we're kind of moving up, pulling back on lighter volume, tightening up a little bit, then moving back up again. We had a nice gap up here. I'll point it out on the chart right here. Then we settled down. This could have been an area to buy. We had an inside day about 5 days later, and then we had a push up from that area. And then we had a nice pullback, a gradual pullback into that brown moving average. I think that's the 23, Jack, on your screen, if that's correct. And look at the volume on this pullback. Super tight price action on very low volume, extremely constructive. And then we had that one day where volume increased. That could have been the first area to buy. You could have drawn a DTL on that flag type area. And then, that would have been kind of the optimal spot right near the 23 EMA. Then a few days later, we kind of had some pullback to the 10-day. You could have bought a few times in there, but now it's just trending above the 10-day. So it might be far away from, the optimal buy point from a position trader, even a swing trader point of view. But we do kind of have a pivot right near 43.50 that you can use. I think it's a little bit later. You don't want to start a huge position there. But it's an area that's been really strong. Obviously, these are going to kind of benefit from an inflationary type environment, discount realty, the overall group. I think BJ's is doing well. I think what are some other ones? Dollar General has also been trending really nicely. Ollie as well. So there's a theme going on, but you want to make sure that even if there's a theme, you never buy just blindly because you think it's going to go up. You're always managing risk and entering a spot where the risk reward is favorable.
What's interesting is that Kroger, also in the grocery field,
right,
isn't doing good. So it's really specific to the discount stores, right, even more than just, you could say, grocery stores in general.
Right.
Because it's right. They're different.
Right.
They're different.
Perfect. I think we should call it there. I've held Jack for an hour and 20 minutes. So Jack, thank you so much for your time. Thank you all of you for tuning in. Hopefully this was helpful. Let us know your questions. We'll see you over on Twitter. If you enjoy the stream, please go ahead and leave a like down below. That lets YouTube know that it's good and can recommend it to a larger audience. And if you want to see more videos just like this one in live streams, go ahead and subscribe. And like I said, we've got the annual trading conference starting next week. We'll be doing that over the course of 2 weekends, the 9th and 10th of July, as well as the 16th and 17th of July. We've got an amazing lineup of great speakers, including Jack right here, as well as Jim Ropel, David Ryan, Jack Swagger, Denise Scholl. So many amazing speakers sharing their expertise. So make sure you sign up for that. I'll drop the link once again in the chat here. Give me 1 second. And make sure you go ahead and check that out. Sign up to the email list. We'll be sending out exclusive material as well. You'll be the first to know about any updates whatsoever. And with that, I think this is a great place to end it. Jack, thanks so much once again for coming onto the channel. And make sure you guys check out his YouTube channel as well as subscribe to him on Twitter. The links will be down below in the description once this is over. So, Jack, any last words for everybody watching?
No, just looking forward to seeing you guys at the TraderLion conference. Stay safe out there. This market is still suspect. Just be careful. And again, thanks for having me on, Richard. I had a lot of fun with you. So appreciate that.
My pleasure. Always love talking the markets with you, Jack. So thanks again. And to everybody out there, enjoy the weekend. Enjoy July 4th. And we'll see you guys over on Twitter. Take care, everybody.
Take care, guys. Bye.